So oil has edged up today, but our guest thinks the demand picture already looks pretty sour. And we are going to see, or we have been seeing, extremely low consumption levels in China and Europe. We are joined by Rory Johnson, founder of Commodity Context. Rory, it's great to see you. You have been crunching numbers, working hard on analyzing demand around the world. What is happening? Is demand down?
Yeah, so thanks for having me, Andrew. And demand is down. And the challenge is that we started the year really strong. And then, supply had been underpacing demand basically since, halfway through 2020. That tightness led us straight through the beginning of the year. And then that's when things really started to fall apart. And they really started falling apart first and foremost in China. From hitting, by my numbers, an all-time high, consumption level in March, then you started seeing those rolling and increasingly draconian COVID-0 lockdowns that shut down, hundreds of millions of Chinese citizens. And we saw demand, implied demand at least, fall by upwards of 2 million barrels a day through April. And we've had a bit of a recovery from then, but it's still down upwards of 2 million barrels a day from the high point of last summer, and still down from those March levels. So Chinese demand extremely weak. It's really one of the weakest segments of the demand picture globally. And the rest of the world, US also not doing so well. And then there's this big question of Europe, where most of the major forecasting agencies are now trying to build in this, gas to oil switching that we're going to see this winter for heating demand. Mm-hmm. But what we haven't seen yet is the normal demand of Europe begin to fall back in those forecasts. And I think that's one of the big concerns that are investors' minds right now.
That's interesting. Essentially, Europeans are still driving their cars.
That's that's what the forecasts are saying, and I think it's reasonable to expect that if we do see such an awful kind of experience through this winter, that you do see large scale gas to oil switching. I do think that you will have some kind of negative effects on the rest of the the normal consumption basket of petroleum in Europe, just because, there's going to be erosion of disposable income. So I think that's something that we haven't seen really manifest yet, right? It's one of, I think, those lingering concerns. And, you were saying that we've kind of been all over the map this week, and we actually started the week pretty strong. And then you got that really hot and heavy CPI print in the US. And I think that's what really triggered this, negative sentiment that we've seen, cascading through the rest of the week, like you were saying, catalyzed most recently by that FedEx restatement.
So we got WTI at about $85, a little bit more. Where do you see it going, say, in the next 6 months? Could it get down to 70, for example?
I think if we continue on this path of kind of deteriorating macro backdrop, I think easily prices could fall $5, $10 a barrel further. I think, though, the important thing to remember is that, I know transitory has definitely become a dirty word in the industry, but, China's lockdowns can't go on forever fundamentally. Eventually, they will begin to rebound. And supply really hasn't picked up at all through this period. Supply has basically been kind of range trading alongside demand, sideways. But once demand bounces back, we're not going to have the same kind of flexibility of supply on the other side.
Rory, can we switch gears and talk about the big fat discount on Alberta heavy crude? About $21. What's behind that?
Yeah, and I think for people that are used to watching the WCS discount, again, this is Canada's main heavy sour export blend of crude. By far the largest stream of our crude exports. That's sitting at, like you were saying, around $21, $22 a barrel under WTI. But I think what's really interesting is that the implied transportation differential, what normally goes wrong with WCS is pipeline bottlenecks or something of that kind. What we're seeing is there's no real signs of stress there. But what we are seeing is the same barrel of WCS trading against WTI in Houston, removing all the kind of Canadian egress idiosyncrasies, is trading at, by my numbers right now, $11.50 under WTI, which is, again, over the last 5 years, the widest differential we've seen, except the kind of weirdness of early 2020. But I think what we are seeing there is a general weakening of demand and therefore pricing for heavy sour barrels broadly. And I think there's a couple big things driving this. You've seen, first and foremost, we're competing directly with the US SPR, which is releasing, last week reached a 1.2 million barrel a day drawdown, the fastest in history. Most of those barrels are still, medium sour competitive grades to WCS. On top of that, you're also having the discounting on Russian barrels, which are kind of inherently competing with, in the heavy sour market as well. And then finally, the really, really high price of natural gas contributes to refinery costs, and those refinery costs are definitely tilted towards heavy kind of reformation.
Rory, I think you'll admit that you spent too much time thinking about the U.S. Strategic Petroleum Reserve.
I do. I definitely do.
I need to get out more. I can't criticize anyone, but tell us, we're tight for time. Why is it important, the SPR?
The SPR is important because it is functionally the largest source of quick response discretionary supply in the market. Unlike normal inventories that move back and forth with the supply or demand surplus or deficit in the market, the SPR is purely a policy choice, which means that it interacts with the market as supply and is thus depressing kind of spot prices, and in Canadian crude grade also our differentials. The assumption is as this wraps up over the next month and a half, that will switch, at very minimum to losing almost the equivalent of Oman's entire production base concentrated in the U.S. Gulf Coast, right where we're sending our barrels.